Welcome back, everyone, to Small Cap Investing Live. My name is Paul Hurl. I'm delighted again to be able to speak to UK legendary stock picker Paul Scott. So welcome, Paul.
Hi, Paul. Hi, everyone.
Well, it's great to have you back on the show. We've got masses of stock ideas to go through. Plus, we've actually got some 3 purchases that you and I have between us made this week, and a hatful of stocks to run through from last week. And I can see the questions are already coming in for this edition. But before we start, a big shout out to our sponsors, GoodMoneyGuide.com, a website that provides information for investors to be able to select a broker account, an investment platform in currency dealing, and also trading. So really useful information. And I would urge every person out there to put a review on their website, if you could do, please, because it'll help keep our lights on this show. So if you want me and Paul to be able to actually keep on doing this, then we have to cover the cost. So if you could do that, that'd be really grateful. Don't know if you've had a look at the website at all, Paul. I'll just put it on the screen.
Yeah, I have. It's very good. I mean, you know what I'm like, and you're the same. I think that we just, we're not going to start advertising crypto or any junk like that. This is actually a good website. It's worth looking at. It's a sort of cross between a price comparison site and a review site, but for financials. And you've got, best buy tables for all the different brokers, and there's a lot of useful information on there. So yeah, I'm happy to recommend it, and many thanks to them for sponsoring us. As you say, it helps us fund the content. So we're very grateful.
And Paul, now a request for you. Can you put a review on the Vox website, please, on the review? Because they've already put a review for us.
3 people of my Substacks on there. 3 people have already reviewed me on there. So if the listeners could do reviews for us on there, that'd be great. Honest reviews, yeah.
Okay, cool. All right, good. Well, okay. Well, let's move on to the stocks. We've got absolutely masses to cover. And I know one stock that sort of caught your eye this week is Science Group, which is basically a company that I have never looked at before, but it's a sort of technology consultancy. In fact, a bit of a hybrid, because it also has a systems business. And I believe it bought TP Group some time ago, which does sort of like air filter systems for submarines. So it's a high tech business. Do you want to take us through how you view this particular company?
Yeah, I'm just looking for which day I looked at it. It was in one of my small cap value reports this week, which are obviously now on my own Substack. Where is it? Was it Tuesday or? I can't remember which day it was, Paul. Here we are. It's Monday the 11th. So it's a business I've followed for many, many years, Science Group. It's owner managed, which I like a lot. So the guy running it seems to have a very good track record of making acquisitions, turning them around. It makes nice profit margins. Quite a consistent performer. Shares have done pretty well in recent years. Anyway, it was a December 2024 financial year that you're currently obviously in, getting near the end of it, and they basically just reassured it trading's on track to deliver another record year of adjusted operating profit in line with expectations. They also quantify the cost of the employer's NI. It's got net cash of 26 million, which is about 12 or 13% of the market cap. So that's nice to have. Now, reading between the lines, I think they're limbering up for another bigger acquisition, actually. This is what I think is quite interesting, because they've secured outline terms for much larger bank and longer term bank facilities secured on its freehold property. So that's another positive thing about Science Group. So I think, given that they've already got 25 million in cash, they clearly don't need bank facilities. So reading between the lines there, I think they've got a big acquisition lined up, and they know what they're doing. And the acquisitions they've made in the past have generally been very good. It's cheap as well. It's on a forward PE of only 13.2 times. Given that it's just confirmed that it's in line for that, that's good. And you got the upside when this deal gets done. So I just think it's too cheap for what it is. So have a look at it. As always, never a recommendation. It's just my view. I think it looks a decent value, overlooked company.
Yeah, and just on the actual margins, I mean, he makes almost 20% EBIT margins, which frankly, it's just shooting the lights out. They must have something there of IPR and pricing power to be able to generate that.
Yeah, yeah. I mean, to be honest, this sounds ridiculous, but I haven't looked into what it actually does in a huge amount of detail. I look at so many shares. I mean, I have done in the past. It's just not in the front of my mind. I know that, you know, I like the stock, and I think it's a good stock, having covered it for many years. So, you know, when I see it on an attractive valuation, I think, well, that's an idea I should be investigating. So,
No, yeah, I would agree. I've not seen that one before. So yeah, top trumps. I'll have a good look at that. I mean, if that type of margin, solid balance sheet, then it looks really good. Now
it is
another one
overall,
on
yeah.
yeah, another one on that sort of vein of sort of like services, mainly in the defence sector that I know has caught your eye, is Qinetiq, which is basically obviously it's done pretty well recently with the shares. How are you seeing this one going forward, given that the geopolitical backdrop is still pretty tough, unfortunately?
Yeah, well, I put it on the list before today's bombshell from Solid State, which of course warned
Yeah.
on profits and blamed it on defence orders being put on hold by the Ministry of Defence with this, what do they call it, strategic review or something. So you might see read across to other defence stocks, I don't know, but Qinetiq is much, much bigger. It's at the other end of the scale. I looked at this one in Thursday's report this week. One of the readers got me onto it. You know, I always say that it's a team sport, this small and mid-cap stuff. You know, you need a network of people around you to flag up good ideas to you. And I'm jolly glad that the reader did ask me to look at it, because I was really impressed with the H1 results. It's guidance for the current year, which I think is, it's a March 2025 year end guidance. They confirmed they're happy with that. They've extended their share buyback from 100 million to 150 million because it's generating a lot of cash. Quite a decent sized mid cap, 2.55 billion. So a bit bigger than I would usually look at, but I don't care what the size of the business is. If people say to look, you know, the numbers are good and it's good value. This is another one that makes a nice, decent operating margin at about 12% on underlying profit before tax in the first half only was 111 million, up 6%. It's confirmed the full year expectations, which look which put it on a PE of 14.3 times. Well, for a business of this quality and size, I would say that's cheap. The balance sheet's okay. Net tangible asset value of 245 million. That's only about 10% of the market cap. So it's not really asset backed, but it's also not mired in debt, which surprisingly quite a lot of mid caps and large caps have got actually really weak balance sheets with too much debt. It surprises me now. I'm looking at mid and larger caps, how reckless some of them are actually with their balance sheets. But Qinetiq is not reckless with its balance sheet, not excessive debt. I like it. Good cash flow. I've looked at all the key metrics, generous dividends and buybacks. As I said in my report, I don't really know that much about the business at all. I think it was spun out of the MOD, wasn't it, years ago, some sort of research organization. But these numbers look attractive. So all I'm saying to people is have a look at it and do some deeper research. I think it looks interesting.
Yeah, I think there's lots of secular growth in this business on the services side because it's got real expertise in cyber security, robotics. Robotics with drones, and all the sort of like, you know, the hot stuff in this sort of like you know, cyber defense and cyber warfare and stuff like that. And so I think they're really, even if there was problems with expenditure elsewhere in sort of like radios or tanks or anything like that, I think these guys would do absolutely fine.
And they reiterated their medium-term guidance as well. It's one of these things where they've given out, you know, we think we're going to do these numbers on revenue and margins in the next X number of years, 3 years, I think it is. So, yeah, I think it ticks a lot of my boxes as a growth at reasonable price type share. So have a look at it, readers, and let us know what you think.
Yeah, no, I like it. We've got a couple of questions coming in. One from Jimbo Jones, another one from Emmanuel, both asking about Warpaint. Don't know for your latest view. This is a Challenger cosmetics brand that has expanded into Europe from the UK and across into the States under its Technique, and I think is it W7 brand or something like that. And they're doing brilliant. They've been knocking the ball out of the park. They had some director sales, didn't they, recently?
They did, yes. I mean, we were on this one at the Small Cap Value Reports. We've been on this one for several years, and I actually interviewed management a few years ago, and I think that was one of the best podcasts I've ever done because I didn't get into all the detail. I just said, "Look, why are your profits rising? Why is this business model working, and is it going to continue?" And he just gave us sort of a masterclass in what they do, and it's basically they just get all this makeup made in the Far East cheaply. But it's well formulated, it's good quality, it's branded, their own brands. They put it into multiple retailers and it sells well. So the retailers buy more. And that's it. That's the business model. And it's scaled up beautifully. The only thing is, the market cap now has got quite high, and directors did cash in some of their chips, but they may remain huge. By far the biggest shareholders. So if you look at the chart, it's sort of rolled over, peaking in July, and is zigzagging down a bit now. So I think some people might be looking at the chart and thinking, oh dear, we've seen the top, they're banking their profits, they were nervous about the budget and blah, blah, blah. And the forward PE is 19.9 times, which of course isn't really cheap. But Warpaint does have a track record of thrashing forecasts, and we often flag this up saying, look, the full year expectations are ludicrously low, it's going to beat them. So the PE may be a good bit lower than it appears to be at any particular point in time. So what's your view on this one, Paul? Have you looked at it?
Yeah, I missed it by a mile, unfortunately.
I kept waiting for a pullback and it never came.
I know. I wish I put makeup on. I'd know about these things and be able to, I'd be a bit more fashion conscious. But I'm a bit of an idiot when it comes to anything sort of consumer orientated. And albeit, it looked very good, I just haven't got the edge in these type of things. I have to just hold my hands up, and I haven't got the expertise to be able to really see what's going to fly. And I missed it, and I'm big tip the hat to everybody who picked it. But I would say it's not cheap at the moment, but frankly, for really good quality companies, you have to pay up sometimes. And I would say, on that basis, if they keep growing and growing and growing, there's no reason why it couldn't get to a £1 billion market cap company. And given its current market cap of 400, that's, if it could double again in 5 years, I would take it every day of the week. But hey, that's me.
Yeah.
No, okay, we got another question coming in. Paul the Parrot, one of our regulars, he's asking, is there going to be a Santa rally this year? Even though we've obviously got a number of fund redemptions. What I'll do, actually, let me put this is the valuation perspective. I'll just put it onto in there.
I mean, who knows is the only answer I can give to that.
Well, all I would say when it comes to the Santa rally is that if when we do get a rally, let's put Santa to one side. When we do get a rally, it could be quite beneficial to the UK, because if you look at the Nasdaq, it's on about 28 times. You look at the S&P, it's on nearly 22 times, 21 times. But all the UK is on about 12 to 13, and that's like forward estimates. Okay. That looks fine. Okay, there's a mean reversion. We can understand a bit of that because of the growth. But what's really interesting is the next one, because when you overlay that to the earnings growth between the relevant US and you put a new PEG ratio, look at how cheap AIM is. I mean, frankly, it's half of what the S&P is and less than anybody else. So if AIM gets anywhere near delivering what its growth's going to be, then there's a significant upside. I don't know what your thoughts. I mean, just on valuation, it looks stupidly cheap.
Yeah, I mean, we're not comparing like with like, though, are we? I mean, a lot of people will say, well, these Nasdaq companies are so exceptional, and they are. Let's be fair about that. They are outstanding. But and most of AIM is junk, as we always say. But I would say out of the 750 or so companies on AIM, you've got a couple of hundred really good companies, and within that, you've got plenty of excellent growth companies that are delivering, and it's just sorting through and finding the good opportunities, isn't it? So I'm not really interested in what the AIM index as a whole is, because I'm not buying the index. I'm just cherry picking the nuggets of gold in there. And what I like is that there's less and less competition, because more investors are giving up and just buying big tech stocks. And all I would say, I've noticed my investing career is sort of 30 odd years, or a bit more actually, but actively investing probably 27, 28 years. All I would say is that when you start to see people giving up on a market and just buying the booming market, they're probably buying much nearer the top than the bottom, you know. And I think it could be a mistake buying into all the stuff that's booming and on very rich valuations. You know, we saw a very similar thing in 1998 and 99. People gave up on small caps in particular in the UK when they were on PEs of 6 and good businesses, and they just said it's going nowhere, it's dying. And you know, that was at or near the low for UK value shares, and very much an artificial high on Nasdaq, which of course crashed in March 2000. So I'm not saying anything's going to crash imminently, but I'm definitely getting echoes of the late 90s right now.
Yeah. I would say, I mean, personally, I would say the catalyst next year is going to be, if it's a show me story for small cap, if they can deliver overall 15% plus EPS growth, which is what's been penciled in, then these businesses, you're going to totally get a re-rating, because it'll be a small window and it'll become a crowded trade and they'll move up. And that's the thing. If we start seeing some positive upgrades on profits, because we've had some downgrades of late, we start seeing positive upgrades this time. Well, it's not earlier, you know, sort of Q1, Q2. You'll see a big pickup in my view. But
I agree, but I think we need to maybe bide our time for a few months on this, because one thing I did pick up on this week that I didn't have time to write about in the daily reports was that I've been saying for a month or two now that broker forecasts for 2025 are going to have to come down because they didn't factor in tax raises. And this is actually now happening. This week there have been 2, I think it was H&T, the pawnbroker, and Foxtons, I think. Brokers actually put out revised forecasts cutting the 2025 forecast, because for the specific reason that the companies and the brokers had not factored in the lowering of the national insurance threshold. They'd factored in other cost increases like minimum wage, and I think H&T dropped, or one of the brokers dropped its earnings forecast by between 3 and 5%. So I suspect you will have a wave of forecast downgrades in that sort of order for hundreds of companies which have not budgeted. It surprises me that the brokers are so behind the curve on this. So short term, I'm expecting wave after wave of broker downgrades, but I think maybe if there are some early signs of economic improvement, it doesn't seem to. I mean, it feels like we're in a recession here and in America. Do you know what I mean? I can't tie up what companies are saying and what the general feel for how life is with this GDP data saying that we're growing at 2%. It doesn't feel like it, does it?
No, I think that's wrong in terms of sort of like, you know, consumers going out to restaurants and stuff. All I would say is that, yes, there's some on cost, but given we talked about last week, it's only been implemented on April the 6th or April the 1st of next year. I actually think you'll start seeing prices moving up. And
definitely.
It's what we talked about was you've got a pricing power, haven't you? And expect your pint of Stella at the Mary Shelley to go up this time by this time next year. So that's really come down to, I think, those quality companies that can push a few pence on the pint or whatever it is, you know, extra, then they'll be able to absorb it.
I know, and with Wetherspoons, because they're 40% cheaper than everyone else already, they can push through a 2 or 3% rise with you barely noticing, and they'll still be far cheaper than the. Funnily enough, on Wednesday, I had a bit of a session at a Wetherspoons in London, and I mean, it's such a good business model. We're sitting at our table talking about shares all evening with this friend of mine, and I was just getting my app out, ordering 2 beers, £8.96 in central London for 2 pints. You know, it's brought to the table. I mean, the place was rammed all night, every table taken. It's such a good business model, Wetherspoons is, and they could ping through a few extra pence on each pint without you even noticing. So I really want to get back into Wetherspoons shares for the long term.
Yeah, no, I agree. Okay, just in terms of stocks we've bought, nice segue into that, because you said be patient, but you haven't been, because I understand you've just bought ADF facilities of ADF, haven't you? Do you want to take us through this one? Came out with a shocking profit warning, actually.
It wasn't shocking. It was very easily anticipated. I mean, back in August, I think it was, I wrote about this and said, look, here are the H1 numbers. Here's the full year forecasts. They're pie in the sky. this thing is not going to get anywhere near those forecasts. It was obvious. So I said in my report back then, look, I'm just going to wait for the forecast to be lowered. Everyone will realize that they're going to be lowered, and it'll only hit the share price by about 10%, if that. Well, I got it completely wrong. It opened 40-odd% down,
Yes.
didn't it? I
Yeah.
just don't understand. And this is where a secondary placing took place earlier this year, and really on the back of those false forecasts. So I think there are a lot of very angry, upset fund managers who bought shares, including our friend Christopher Mills. He took 10% of the company at 50p. Well, anyway, so that was the reason I didn't hold ADF. I like the company, but I thought it was going to run on profit. And it did. So I nipped in and bought some at 33p, but I broke all my own rules because I hadn't seen the revised forecasts. And when the revised forecasts came through, I thought, oh, they've really, really slashed the forecast. So I probably made a fairly basic error there, jumping out. Although it has actually moved slightly above what I paid. So I've made a bob or two on it, but maybe more through luck than judgment. So I'm going to stick with it, though. It's only a small position. So that was a share I bought this week. And in order to pay for it, I just slightly top sliced a few other existing positions, not enough to make any difference, really. Have you looked at ADF?
Well, I mean, look, I've put it on the new numbers, and it's trades at 6 times PE next year's figures, and the whole investment case, the whole investment case is predicated on there being a rebound next year in movie production, and that's the essence of it. I mean, what you've got some of the industry insiders thinking that there is going to be a rebound, i.e., such that you've got that new studios being built, which is, I can't remember where it is. There's a big increase because the UK is a sort of like a hotbed of movie production outside broadcasting and stuff in the world, where Harry Potter and James Bond and all this sort of stuff. So you would have thought that would be a good sort of like backdrop. Plus, obviously, concerts and live events are going gangbusters because they've just bought that track business, haven't they? But
portable roadways,
roadways. So that's another good rental thing. So I think it's a good quality business myself. It comes down to the thesis: do you think outside broadcasting, outside movie production, is going to bounce back next year? So it's a show me story as much as anything to me. But it's super cheap, and lots of bad news has already been priced in.
I agree with that. And the other thing is, because it's renting out quite expensive capital equipment, like the big Arctic trucks and all this sort of thing, you've obviously got huge operational gearing, but it's cash generative even on low levels of revenue. Because of course the depreciation charge is enormous, so it does genuinely generate cash, and its balance sheet is fine. I had a look at that, it's all right. Whereas the one in the same sector that I think on the same day warned on profit again was Zoo Digital. Now Zoo Digital doesn't have that asset backing. It's rapidly running out of cash. I don't rate Zoo Digital at all. I think management have made a right mess of things. They're only cost cutting now, but they've burnt through almost their entire cash pile. So of the two, I think just on operating, because obviously they were hit hard by the Hollywood strikes. Nobody can blame either of these companies for that. But I think of the two, the one that I think is much safer, that will definitely survive and should prosper once demand returns, I think is ADF more than Zoo.
Yeah, no, I totally agree. I actually think the Zoo Digital business model could be disintermediated by AI. And give you an example, just look at Notebook LM, which is that Google sort of like podcast service. I mean, it is the quality of the dubbing and the speaking is fabulous, and I'm sure they can do the same for movie production. So I wouldn't be jumping headfirst into Zoo, that's for sure. What was quite interesting, actually, they had an IPO in that area, in the gaming, which was Winking Studios this week, that raised about 8 million quid, I think. I don't know if you had a look at that. Basically, it does sophisticated art design for gaming out in Asia. They've listed in the UK, I think, because they want to actually grow in the UK and abroad to lift and shift their model. That's what. And what they've also got is this basically quite sophisticated generative AI art design software that they've developed in house. That they're beta testing and hoping to sell that as well as obviously their core art design. But it was quite the shares have done well actually.
I saw they were up today, weren't they? They went live yesterday or the day before, and I think they've gone to a premium. That's key, I think, to AIM coming alive again. You need some fresh IPOs of good quality companies at reasonable or even low prices to get investors interested in IPOs again. And particularly with a lot of these things where the amount being floated is actually quite small, it's better to give the shares relatively cheaply to the new investors and then let the share price get into a healthy uptrend. That's better for the existing majority holders in many cases. This thing, I've only very briefly looked at it. I noticed it already has a listing in Singapore. So they've gone for a dual listing, which that might, correct me if I'm wrong, but I wondered if that might invalidate it for IHT relief in the UK.
That is a really smart comment, actually. Yes, it does. It does. Yeah. Yeah. No, you're right.
I don't know why go for a UK listing at all when you've already got a listing in Singapore? I don't know. It seems a bit odd, but
they want to use basically as a base to effectively to raise money in the UK to make acquisitions in the UK or the Europe rather than actually using.
I noticed it already. The RNS said it already had a nice healthy cash pile, which is encouraging, and they've just topped it up with a placing over here. So one to watch. I'll keep that on my radar, but I don't really know anything about it yet.
Yeah, no, I mean I looked at it, and they've got about 105 million market cap as of today. $43 million is cash about. And as I say, apparently they've got a good reputation for it, but again, you've got to sort of like look at it and you think, gaming, how's that going to be impacted by, sort of generative AI, albeit Keyword Studios, which is exactly the same, was bought out by private equity just recently.
Yeah. It's generally a sector I avoid. But good luck to Winking Studios. Got to be very careful how you say that.
Yes, you're right. You do. Don't say it after a few Stella. Okay, got a question coming on hot off the press actually, because Ben Sharman's asking about the TT Electronics and Volex potential acquisition.
Yes.
Is this going to go through, Paul?
Good question. I spent most of the morning on this, actually. This was really the biggest story in small cap world. Well, this and solid states profit warning is what I've majored on this morning. There were two announcements from Volex, the electrical connections and sub-assemblies type business. Interim results look fine to me. They're in line, and the confirmed full year expectations. Nice organic growth, actually. 10% organic growth, and then another 20% on top from acquisitions. This is Nat Rothschild's buy and build acquisition vehicle. He doesn't seem to have put a foot wrong from as far as we can tell, making nice, stable operating margins between 9 and 10%. They sort of buy things and then, bring in some buying efficient group buying. Obviously, they can buy plastic and copper. The bigger the group gets, the better prices they get, and they improve local management where it needs improving. So I like what Nat Rothschild is doing. I've been green on Volex 5 times now this year when I've looked at it. It's one of my favorite growth at reasonable price shares. Forward P is about 11.8. Does have a fair bit of debt, but it's only about 1.1 times or 1.3 times EBITDA, so not a problem. So a thumbs up from me for Volex. Then a second announcement where it said that it's been rebuffed twice from a bid approaches it's made to TT Electronics, which has been a disaster share, which funnily enough I covered yesterday in yesterday's small cap value report. It put out results and I couldn't make up my mind. I said, look, this is on a TT Electronics is on a forward PE of 4.4. And historically, it's been a pretty good business. It's still making decent operating margins, but I was scared off by the balance sheet. TT Electronics does have an elevated level of debt that I'm not comfortable with. So for that reason, unfortunately, I was tempted to nibble at it yesterday, but I was scared off by the debt. What a pity, because today Volex have offered, a 70-odd% premium for it. Although the Volex offer is, I think, 62.9 pence in cash. And the rest in Volex shares. And funnily enough, I've put up a little ready reckoner on Google Sheets. which tracks the live prices of TT Electronics and Volex and tells you what the current value of the bid is, because obviously the share prices are changing. So have a look at my Substack for that. That's available to everyone. I actually think this deal is a good one. I think Volex, look, we don't know all the ins and outs of either company, really, do we? But if Nat Rothschild wants to buy it and turn it round, I think he'll probably succeed. And Volex were very critical in their announcement to the stock market today about current and former management at TT Electronics, just saying basically they've overpaid for a whole load of acquisitions. The whole thing's a bit of a shambles in the way it's run, and the share price has lost the bulk of its value over the last 5 or 6 years, during which time Volex has been doing the same thing and our share price has tripled. So, well, you can't argue with that, can you?
No, totally get it. No, I mean, I think you're right. I think that there's a good chance of the deal going through. Just look at the share prices of both of them. The market is saying, actually, you know, the shareholders, the institutions are voting with their feet, aren't they? That
well, the only thing is, though, Paul, Volex shares have dropped by about 10% today. I mean, it's quite volatile. And the problem is with deals that involved paying with a significant amount of paper, if your share price then tanks, that in itself will kill the deal, won't it? So, but you see,
I was going to say the opposite. Actually, I was going to say that's actually what you'd expect when it's a stock offer. Then you'd expect that to occur because obviously you're diluting it. But I think the market is saying, which is agreeing with what you've just sort of like you thought about, is the deal is probably a good fit actually.
Yeah. I mean, obviously, TT. I actually wrote their rebuttal piece for them this morning. I said it hasn't come out yet, but this is what it's going to say. This materially undervalues our business. It's an opportunistic approach. We reject it because our turnaround plan will deliver far greater long-term returns for shareholders. There you go.
Good. Okay, right. Well, we're halfway through, and I've got to remind you, Paul. Make sure you put a review on the Vox page on the Good Money Guide. And if you do, actually, it gives you a 50% discount to their proprietary sort of like intelligence service, which is sort of like how to do portfolios and how to do your sort of stock picking, etc. So, if anybody wants to join Paul, put in a review on Vox Markets or any other provider, then please do, because that'd be great. And I think you can either sign up for a week's trial at £1, or alternatively you get 50% off for the whole 12 months. So that's just a reminder. Okay, good. Let's move to another stock that one of us bought. In fact, I've bought, which is CML Microsystems, which I know you like, and this one is a sort of like a niche semiconductor provider for sort of like, it does supplies things like into aerospace and defense, but largely into sort of like communications technologies, so satellites, maritime, base stations and stuff like that. I'll just put a quick slide on it. It's got what's really interesting compared to a lot of semiconductors. It's fabless, and it generates about 70% gross margin, so it's IPR rich. It goes into, say, discrete levels, and one other sort of like quite good growth driver it might have next. Well, they think it is the digital broadcast radio. Its chips are sort of 60% lower cost and 80% lower power, and it's been affected just recently by destocking. But what's piqued my eye is that it still pays a really good dividend, 4%. And I think it's just hugely undervalued for a high IPR rich business. And it's got some spare land as well, which is hoping to sell for probably about 5 million quid. It's got net cash on the balance sheet, a lot more than that at the moment. But by the end of next year, I'll have about nearly 10 million, which is about 90p a share. And I think when you put it all together, it's a cheap, high IPR rich type business. Anyway, I bought some shares this week, so I thought I'd just take people through it. I don't know if you've had a look at this one, Paul.
Yeah, I followed it for years. I mean, funnily enough, I nearly bought some recently as well. But on the day, it's so thinly traded, the bid offer spread was prohibitive. Yeah. It's a hybrid share where you've got, as you say, about half the market cap in net tangible assets, freehold property and cash. And so you're only really paying quite a low multiple for the business, but it has had trading problems. But it's very unusual for a small chip developer. I mean, you had that dreadful thing you bought that did really badly, Sondrel, and then you got another one, IXICO, which I don't know, I can't make my mind.
Yeah.
But CML Systems has plodded along for donkey's years, and it makes profit nearly every year.
Yeah.
And yet nobody's interested in it. So I need convincing that what is going to change, given that the share price is now pretty much exactly where it was 20 years ago. So you can't really say this is an amazing blow the lights out growth stock. So what do you think is going to change to actually turn this back into a growth story?
I think basically you'll have destocking will end, and therefore you'll start seeing, we say, with the implementations of high-speed wireless, so things like 5G, Internet of Things, M2M. You've obviously got the defense; they do jammers and aerial drones. The digital could well take off in Asia. I just think they've got so much IPR in here. If they can't, sort of like given the secular growth of all things chips, if they can't make a fist of it, I think somebody will put a number on them. I mean, they've got 95% client retention, Raspberry Pi being one of them. They must have something with 70% gross margins. You don't generate that unless you've got some IPR.
Yeah, but I mean, it only makes sort of 1 to 2 million, maybe 1 to 3 million profit every year in, year out. It looks like a mature value type share. This is what I can't quite fathom, really.
You might find they do too much engineering. They spend too much on R&D, and if they had a really astute sort of CEO focusing on the commercial side, then that might. Anyway, I've dipped my toe in. Well, I've bought a position, so let's see how it goes. I think they've got.
It just needs to demonstrate that it can actually get growth going. It's not a growth company. That's my only. It's a value share. But it's still. I think it's still good. Don't get me wrong.
Yeah. No. Okay, good. Let's go to another one you like. We've got Cakebox, which came out with results, which is the UK's #1 sort of fresh cream cake provider. I mean, my family's used their products lots of times. They love it. But how do you see it? It's a franchise business.
Franchise business, yeah. It's a self-funding rollout, which pays lovely dividends. So you're getting about 5.2% dividend yield, because of course the the capex for opening all the shops is paid for by the franchisees. And they make their money from franchise fees and from supplying all the ingredients from a central sort of, what do they call them, repository or whatever. And I just think, it's a nice owner-managed business. Ran into major problems a few years ago when, I better not say anything too rude about the former FD, but he was not somebody I would trust as far as I could throw them. But he's gone, and they brought in a new FD who I think seems to have done a very good job. And although it had all sorts of accounting problems, the auditors warned about, it was a real mess. And you can see that in the chart. If you zoom out to the chart, it peaked at nearly £4 in late 2021, which, the whole market for small caps was very toppy in 2021. And it dropped as low as just over £1. 18 months later. So it really created a big overhang. But they're now in a nice, gentle uptrend. They've just been wiggling up to nearly £2 now. I think it's still good value, Paul. Forward P 14 times. I think this was an inline trading update. I can't remember exactly. 5.3% dividend yield. It's only 4 times tangible book. So you've got net cash on the balance sheet. You've got freehold property. I just think it's a nice, overlooked little growth company.
I remember last time, about 6 months ago, I think your biggest gripe was that it didn't do diabetic cakes.
Yes, they should do.
Sugar-free.
Because I'm on a completely sugar-free diet now. And it's great. I've lost a bit of weight and I feel a lot better. So yeah. But no, I mean, cakes for celebrations and so on.
No, it's good. I mean, I think it's an affordable treat rather than discretionary spend. So should.
So now you've been very keen on Cakebox for a long time. So
I think it's a founder model basically. Suk Chamdal is top drawer in my view. If you speak to him, he's just so passionate about it, and to get the product to kids, and he just loves the sort of like the whole feeling and the emotion aside, that is generated with the pleasure that he gives cakes to families and to kids and all this sort of stuff.
I've never met him, but I've seen him on lots of webinars. Just a nice down-to-earth owner manager. That's what I want. A self-made entrepreneur just immersed in the running of the business. I want that any day over a gravel-voiced, $5,000 suited sort of city type, you know.
Yeah. No, I agree. Got a quick question from Lemon Physical. He's asking about Van Elle. Have you ever looked at that? It's a piling
Yes,
business.
I like that one. Yeah. I like that one a lot. Can't remember any details about it, but yeah, that is a nice value share. I think it's got very good asset backing. Here we are, Van Elle. Yeah, I was green on it on the 14th of July. Early signs of recovery, capacity increase, partnership deal, strong balance sheet. I concluded it. This is in July, so it's a bit dated now. Looks cheap, good recovery potential. That was at 37p. What is it now, Paul? Have you got the live price?
Yeah, it's 40.
40, so up a little bit. Yeah. I think it's good.
No.
It's another one. I think that's the type of thing where doesn't it do groundworks? So
it's basically a geotechnical equivalent to Keller. It just hasn't got the US exposure. Keller's just gone mad because it's just done perfectly positioned for the US, but it does almost identical stuff, mainly for the rail industry and because it does these. I can't remember. They're basically to get underneath the cable, so they do piling on railing, and they do for houses and stuff like that. But they're nearly all UK rather than actually overseas.
And it looks like it might be at the right point in that sort of cycle to start looking at buying this because the groundworks happen first, don't they? At the first early stages of recovery and
good point.
Construction. So yeah, I do like Van Elle. I've never bought any shares in it, but I think it could be a good one for people to do a bit more research on. Yeah.
Yeah. No, I remember they were listed originally about 15 years ago at £1 or £1.10 or something. So they've still got plenty of catching up to do, no doubt about it. Okay, good.
Things, it's just you've got to buy them at the right time and sell them at the right time, haven't you?
Yeah.
I don't think this is about buying and holding forever is necessarily the right strategy, actually.
Well, I tend to look longer term, 3 to 5 years. Another one I've just bought, which is the third we just mentioned, I know you've sort of had a look at it in the past, is IXICO, which is basically the brains behind brain scans. What they do is they're like a contract research company, but specifically in neurological diseases like Parkinson's and Huntington's and Alzheimer's, and they help biopharma develop and test their neurological or neuroscientific drugs. And what's happened just recently is last year you had Eli Lilly and Biogen having their major two Alzheimer's and dementia drugs being approved. And that's meant that it's sort of like created a huge number of sort of like a deluge of new candidates going into clinical trials. So these guys help the biotech through their clinical trials. And also there's going to be a lot of post-marketing surveillance in brain scans with these two drugs now on the market because they do have side effects. And so you'll need ongoing brain scans. They've got a new management, new CEOs come in who's I've spoken to him, highly dynamic. What they do is they've got an AI based sort of pattern recognition system covering sort of like, more than 150 unique brain structures, 250,000 digital images, etc. And this is a highly contextualized database, so you can't actually copy it. And they're aiming to double sales, admittedly from a low level, but because of the operating gearing on this, it's sort of like drop through rates of 70% plus at the gross margin. You'll see a break even around about 8 mil. They're doing about 5.5 mil. Forward next year is about 6. They had a big placing at 4 mil. They did 4 million about a month ago at 9.5p. Octopus came straight in with 18%, and it is high risk, high reward, no doubt about it. But I think they're in the right place at the right time. Hence, I've bought some shares because I know that the new candidates are coming through. I own both Roche and Bristol Myers Squibb, and both of those are $100 billion, $200 billion businesses, and they've got really big positions in neuroscience. They're putting huge amounts of work into it, and they're going through late stage trials. If they can get any of this, and they're the number one provider in Huntington's, these guys will be a game changer. And I'll put the chart on, which is a bit scary, but I do think it's bottomed. But hey, we'll wait and see.
Yeah, well, I bought some of these last year actually, because it looked ridiculously cheap.
Yes.
And what I like about it is it's not just a blue sky thing. This has actually been profitable. If you look
Yes.
back at the 5-6 year history, this was doing around 9 or 10 million a year revenue and making a profit of about, well, between 500,000 and 1.5 million. So, it has been a moderately successful small business before. But the reason the share price looks like that is because the revenues dropped down to below the level where it's actually a viable business. So, and as the cash pile was depleting, I just decided to sell mine. So I did exit this one whenever it was, maybe spring of this year. But it looks like, there's been a bit of a blip up in the chart, hasn't there? And I like the fact that it's raised money. So I might look back at this one. And the old management were leaving. It struck me that they kind of more or less given up. And I didn't really feel that the new management seemed terribly excited about anything. But I mean, I am about 6 months out of date at this one. So thanks for flagging it, Paul, and I'll take a fresh look at it.
Yeah, I mean, I've asked the questions. They're fully funded, basically, with that form.
Yes.
That was oversubscribed. They could have done a lot more, but they didn't want to obviously dilute too many, too many people. But as I say, what I like when I come to stock pick, I like high gross margins, lots of sort of like IPR rich, where it gives you pricing power. You've got something that is unique and is differentiated. Hence, I tend to go for software, technology, or healthcare. These guys have got lots of IPR, no doubt about it. You just cannot get 250,000 brain scans and an AI, it's a highly contextualized database with all the AI swings and bells off the top of it, and be able to put that as a service to the likes of Roche or Bristol Myers or all these massive, big biopharma. So they've got a really good position. And the reason why my thesis is that there's a surge in drug candidates going for neurological diseases.
The interesting bit. Yeah. We'd probably better move on because it's only 8 million market cap, isn't it?
Yeah, sorry, mate. Okay, let's go to another one you like, which is 4Imprint.
Yes, so the ticker is FOUR. This is, again, more of a mid-cap. I've followed it for donkey's years, and again, another one where I just didn't buy because it always looked a bit too expensive.
Yeah.
The chart's just gone like that. You're a major multi-bagger. Anyway, it's come down to what I think is now quite a reasonable valuation. Forward PE of 16 times. Dividend yields quite good, 4.1%. Balance sheet's fine. It's got plenty of asset light, and it's got plenty of net cash. I think this looks very interesting. Now, I don't know why the market is on a bit of a downer about it, because it put out, I think it was either a trading update or results that I wrote about in my Substack this week or last week. And I thought the figures looked fine and the outlook looked fine. They basically said that, it's a promotional goods company that personalizes promotional goods, operating almost entirely in America. And they said that the market's a bit soft at the moment because people are, a bit cautious, business owners are a bit cautious, which again doesn't tie in with apparently this supposedly booming economy in America. But anyway, I just think it's a nice business at a reasonable price. So over to you, Paul. Let's hear your view.
Yeah, I mean, it isn't the kind of thing I would particularly go for, promotional sort of marketing. I don't really understand the industry. However, having said that, these guys through thick and thin have been winning market share, been consolidating the industry, hoovering up things cheaply, adding them into their platform, and they haven't put a foot wrong. So I would say the management team is like Pele, basically Georgie Best, or all the top footballers who are running this team. And frankly, they're just doing a great job compared to the rest of the industry, because you wouldn't have thought there would have been a sort of like a huge multi-bagger over many years. But frankly,
right. Well, I remember
superstars.
Funnily enough, I remember, this must be at least 10 years ago, probably more, Reg at MHP Communications, who's a great guy. And he said to me, I went for lunch with him. This was a long time ago. And he said, have you looked at 4Imprint? He said, that management there is so good. He said, that one is going to be a big winner. And I mean, at the time, God knows what the price was, £4, £5, something like that.
Yeah.
It's 10 or 15 bagged since then. I wish I'd listened to Reg. So in future, I'll pay closer attention.
Well, there's I don't mind missing a few. I mean, as long as I can get a few as well, that's the sort of the key. I had a question from.
It's all about backing management, isn't it? Everything we do really is finding the best management with a really good business model.
Yeah.
And just backing them, not saying like I did, oh, it's on a PE of 24 times, it's too expensive. You know.
No, you're right. Yeah, or alternatively, backing a good business in a good sector with rubbish management, because if you do that, it ain't going anywhere either. I've been there many a time.
Me too.
Yeah. Okay, we've got one question from last week we didn't cover. I know I think you own is Zotefoams. I don't know if you want to take us through this one, because it's had a good profit upgrade, or should we say their base business has done well, but they were a bit quiet and a bit subdued on their resource sort of recycling carton thing.
That was it. Now, there's been a change of CEO here, and the last update on Zotefoams put out said that their fully recyclable single material development project called Resource with a Z, they were super excited about it, basically. Well, the new CEO's got his feet under the desk now, and I think for about 3 or 4 months. And his update recently almost kind of pushed it into the undergrowth. It was, we're focusing on our core businesses. And apparently he's told the brokers, but I don't remember seeing this in any of the RNSs. He said he's not going to fund any more losses for this project beyond this calendar year, which is telling you they're on the brink of abandoning it. Well, you couldn't get a bigger U-turn, really. So I was a bit perplexed by that. So what that basically means, I think, obviously the market seems to have anticipated this. Leaky ship, I don't know. But where it's got to now, I feel, is that the core business is now very good value. So I'm more than happy to hold Zotefoams, but I just think it's changed now from being an exciting, moonshot with a value business with a moonshot attached, to one where you're just getting a better value core business. So it's got a lot of things going for it, lots of positive stuff on the in the latest news flow. But maybe the resource project, we need to kind of wind down expectations for that, which the market's clearly done. I think Canaccord put a note out saying basically now the share price doesn't include anything for resource. It's just in for free now. So if it does suddenly, if they do get a development partner and it takes off, you've got that in for free, haven't you? But I think upside case, it's now just a kind of value stroke go up share, not a blue sky moonshot thing.
Yeah, I would say they've signaled to the market that they're going to sell it if they can find a buyer. They'll basically want to sell the IPR or put it into a joint venture or something. But
joint venture would be good. I think I would see that as a success. But look, any upside we get on resource is free upside, so that's okay, isn't it?
Yeah, actually had a comment on the on Van Elle from Ben Sharman. He says Van Elle do have a good rail business in Canada, so they must be doing quite well. In that case, that really is. Thanks, Ben, because that is a really good thing to have a look at, given what we know that Keller's profits have largely come on the back of the US. So I'll have a look at Van Elle. Got a question coming in on Goodwin. Emmanuel du Agriel. He's basically asking about what your views on this one. It's an engineering business, I think.
Yeah, I've always liked this a lot. One of our subscribers, Rhomboid1, is very good at keeping us posted on Goodwin.
Yeah.
It's completely reinvented itself with various new product lines that are on large framework agreements and things. I'm not really up to date on it, I've got to say. Last time I looked at it was its April 24 results, which were released in August. Now the shares were £77.80, and I said good results, but the valuation's too stretched for me. But I do really like the company, and I wouldn't claim to be an expert in it. I think there's some other guys in the community who've done much more work on it now.
It's family owned, I think, isn't it?
Yeah, it is. There's loads of Goodwins on the shareholder register. Yeah.
So what that means, just for investors, given what they've just done in the budget in terms of making, they've taken BR relief away from family businesses, you may find going forward a lot of family-owned businesses wanting to avoid that inheritance tax of 40% that's going to destroy. They'll either leave the country, sell themselves, as in like, or effectively IPO some of the shares, such that people over time can gift the shares to other people under the 7-year rule to avoid that sort of like the cliff edge of inheritance tax at the end of it. So all I would say is that if you're a family-owned business like this one, you could see some good value creation over the next 3 or 4 years, because the family will want to avoid that potential, lightning strike where one of them gets hit by a, whatever it is, and therefore, they'd have to pay inheritance tax. I don't know. It'd be interesting anyway.
Yeah, good point.
What have gone from coming Paul Elle asking about the fund manager industry and Premier Miton in particular, Paul. I don't know if you got any thoughts on that one.
Yeah, I haven't really. I did like it previously, but the big I'm not fully up to date on it. The number one question is obviously fund outflows, isn't it? That is why these things are on. I did like it though. I see the dividend yield's 10.9%, which is normally at that level, something's wrong. That's probably not sustainable. It's got a decent balance sheet. Let's see what the broker forecasts have been doing. Broker forecasts were cut a long time ago, but haven't changed that much actually. So are you a bit more up to date? So basically, I like the company. I think the shares are cheap, but it all depends whether they can hang on to the client cash or they're seeing it leaking away. I mean, are you a bit more up to date on this one?
Yeah, I mean, all I would say, I don't own the shares. I did previously. All I would say is that the sector's been hit by passives. The whole move to ETFs and trackers. At some point in time, I'm convinced we're going to get a moment of truth, and the dumb money is going to get cleared out. We saw a flash crash in August. We've had flash crashes in, basically before. And I think at some point in time, there's going to be a price discovery moment whenever that happens. And then people will start realizing, actually, I can't just buy dumb money, ETF, trackers and all that. I actually have to get somebody who knows what they're doing, because there's no valuation overlay on these passives. And the Premier just being hit by it, like all the fund managers. At some point in time, that will change, but it'll take a frightening moment to make people realise.
Which is the dumb money? The money in the Nasdaq trackers, or the money in UK small caps? Maybe we're the dumb money.
Yeah, I know. Yeah.
I should say as well. Actually, I looked at the schedule today for Mellow Derby, which I think we're both going to be there.
Yeah,
we're both there next Tuesday and Wednesday, and I saw Gervais is giving a talk called something like "Prepare for the super cycle in small caps."
Okay, great.
And I thought he's been saying that for about the last 10 years.
Well, to be honest, I might well enjoy. I'll join him on that one, because I think next year is going to be a great ripper year for small caps. But just on valuation grounds. But hey, well, let's wait and see anyway.
Oh, I know the other thing I meant to say on that, Paul, as well is of course, they're being picked off by acquirers. So although the small caps space might feel pretty dead a lot of the time, every now and again you wake up and you suddenly look at IXICO. People who had the foresight to buy that just got 120% premium bid. So if you've got a nice diversified portfolio of value and GARP shares, if you've got 20, 30 shares, you'll probably get 2 or 3 premium price takeovers each year. Well, that's quite exciting, I think.
No, I think you're right. No, IXICO is a bit of a sore wound for me, because Lawrence Hulls from Dowgate tipped it to me when we did a fund manager interview about 9 months ago, saying it was undervalued. And anyway, so he's been proved right. He was the guy who used to work with Staveley at Gresham. So
I wonder what they're going to do with it, because those. It's had lots of different incarnations previously to IXICO. It was Plus Exchange, it was OffX. It's had all sorts of incarnations. None of them have ever worked. So I wonder what the Swiss acquirers of it see in it, and what are they going to do with it? I mean, because it's been bought by a big Swiss stock exchange group. I think if some fresh eye, some new people with lots of money coming in, maybe they're going to rejuvenate UK small caps with a new market. And there's something else called, is it Phoenix or something like that? There's some new small caps market that's starting up. So I don't know, maybe it needs fresh ideas and fresh concepts to because AIM just generally feels a bit stale. It's the regulatory and costs side of listing and doing fundraisers are far too high. Yes. I think we need something much leaner and where you can quickly raise money instantly by doing an electronic sort of 24-hour fundraise, minimum paperwork. We could transform UK small caps if we swept away this 30-year out-of-date regulatory system, I think.
Yeah, no, I'd agree. I mean, I read a report that the average audit report, just doing the audit for AIM companies now, is about £120,000 per company. And I think that's like crazy. You know, it's so regulated.
Yeah, you look at so many small caps, anything making under £1 million a year, it cannot be worthwhile having an AIM listing. It's just, what benefit are you getting from it? It's probably costing half of your profits.
Yeah. Right, we've got to just go quickly on a few companies. We've got Gerald Oates asking about TPXimpact Holdings, which I don't really know what it is actually. But
I looked at that one. Potentially interesting. It does public sector IT contracting work. It's just won a nice contract with the Ministry of Housing and Local Communities for about $6 million a year. It nearly went bust a year or two ago, but it's sorting its problems out. I think that one's worth a look. I've covered it. I wrote about it a few days ago, so have a look on my Substack, which is still free. It's going to be free for until after Mellow next week. So yeah.
Another one was NWF Group, which I think is a farming agricultural business.
Agricultural business. I always get these muddled up. There's two, aren't they, that are very similar. NWF. I looked at that at late September. Inline trading update, outlook unchanged, amber green. So it's a value share. I can't remember. They might have put something out more recently. I can't remember. But yeah, broadly speaking, I think that one's quite interesting.
Yeah. Okay. And then we've got a final one from James Porter asking about Luceco, which is, I think, is the.
Yes. You like that one, don't you?
I can't remember what they do actually.
They import. They've got branded electrical products that they import. They get made up in China, and they're quite well-known brands. I'm just struggling to think what the actual products are now. It's owner managed. It put out a Q3 trading update in, here we are, 24th of October. That's recent. I looked at it at £1.48. Inline trading update, 238 million market cap. Wiring accessories, that's it. And they do EV chargers and a few other things like that. It had a problem with destocking for a while, but that seems to have washed through now. And it's done a recent acquisition of about £30 million. So I think, what are the shares, Paul? Have you got the live price there?
Yeah, 133.
Oh, well, that's not bad. I liked it when they were £1.48 recently. So I like it more now. It's £1.33. So yeah, potentially quite good, that one. So yeah, have a look at it yourself and let us know what you think.
Yeah, got a quick one actually from Dave Hermes. He's asking about, I think it's me actually, on or Finseta, which is basically you don't like payments companies, do you? This one is, but this one basically is an online payments platform. Hasn't good strong interims. I mean, it's basically now in profitability, generating cash. Personally, just for me, I think all that sector is going to do well, and Finseta is the smallest of them, and I think it'll do well as well. But hey, that's have a look at some of the broker notes on those because it's certainly one to watch. Good. Okay. Just finally, then, I'd just like to say again a big thanks to our sponsors, GoodMoneyGuide, and I'm going to urge everyone to put a review on their website because if you do, then we can keep funding these weekly shows. So that'll be really, really helpful. But again, like yourself, Paul, big thanks for your contributions. I'll see you at Mellow. You're presenting, I'm presenting, and then we're going to come back with hangovers on Thursday and hopefully sort of prepare the ground for next Friday's show. So.
Absolutely.
Any thoughts about the week ahead at all for investors to prepare for? Any big sort of like events which might occur other than Mellow?
Not really. No. So yeah.
Okay, cool. All right. Well, thanks again, Paul, and look forward in chatting same time, same place, 3 p.m. next Friday.
Great. I think it's wine o'clock now. So thank you very much, everyone.
Yes, wine o'clock. You're right.
Take care.